Welcome to Luxembourg Fundcast show. This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Welcome, everyone. Today we're doing a deep dive, really plunging into Luxembourg's financial world. We're zoning in on corporate finance and fund operations specifically. Our mission, really, is to unpack the source material you shared. You know, the official regulatory stuff, reports, legal text. We want to pull out the key insights, understand the main directives, who's responsible for what, and, well, get a grip on the crucial operational frameworks holding it all together.
Absolutely. And it's a complex area, isn't it? It's always evolving. So this deep dive should really help clarify how the EU rules and the national rules here in Luxembourg interact. We'll be using insights straight from sources like CSSF circulars, EBA and ESMA guidelines, Luxembourg laws, and even European Commission findings.
Okay, let's get into it. Luxembourg's known globally a top financial hub, especially for funds, cross-border services. Why is it so complex to navigate?
Well, a big part of it is that it's not just one set of rules. It's actually a mix. You've got EU legislation setting the baseline, and then Luxembourg's own national rules that implement or sometimes add to that EU law.
Right. So who are the key players at the EU level then, the ones really driving things?
Well, you definitely see a lot of influence from ESMA, the European Securities and Markets Authority. Their focus is really on investor protection, stable markets. You see their hand in things like STS securitization notification.
Simple, transparent, standardized.
Exactly that. Originators or sponsors notify ESMA directly. ESMA is also big on corporate reporting standards, especially now with non-financial and climate info, and their guidelines, say, on risk assessment for central securities depositories, they tend to filter down into national practice pretty consistently. Then, of course, there's the EBA, the European Banking Authority. Their focus is, banking. They work on consistent prudential regulation. Think AML/CTF guidelines, that's anti-money laundering, counter-terrorist financing standards, for loan origination, monitoring, and the technical bits of CRR-CRD4.
The CRR-CRD4 capital requirements.
Right, the capital requirements regulation and directive. And like ESMA, EBA guidelines get woven into the Luxembourg system, usually through CSSF circulars. And overseeing a lot of this is the European Commission. They propose laws, make sure they're applied correctly, and importantly for corporate finance, they watch over state aid.
Okay, so bringing it back home to Luxembourg, the main regulator you deal with day to day is the CSSF.
Precisely. The Commission de Surveillance du Secteur Financier. They're the primary prudential supervisor here. They oversee banks, investment firms, payment institutions, securitization vehicles, other financial sector pros, quite a range. And they're the key authority for AML/CTF supervision for these players. Their circulars are where you find the real nitty-gritty, the practical implementation. Like CSSF Circular 2100 and 10.8.2 implements those EBA MLTF guidelines we mentioned. And CSSF Circular 200-0824 puts the EBA loan origination guidelines into practice locally. If you look at the hierarchy, EU regulations apply directly. EU directives have to be put into Luxembourg law, like the law on the financial sector or the securitization law. Then the CSSS adds its circulars and regulations for the specifics. You find these sources on Eurlex for EU stuff and Legilux for Luxembourg law. They're public.
So it's kind of a two-way street then. EU sets the goals, CSSF translates them, adds the Luxembourg flavor, and enforces.
That's a good way to put it, yes. And because it's so integrated, any big shifts from ESMA or EBA usually mean changes coming down the pipe nationally. You really have to keep a close eye on both levels. It requires constant vigilance.
Okay, that makes sense. So what are the fundamental ideas, the core principles that underpin all this regulation? What does everyone need to get?
All right, if we boil it down, there may be three core areas. First, robust risk management. Second, stringent capital adequacy. And third, especially relevant for corporate finance setups, state aid considerations and the arm's length principle. Risk management is just everywhere. It has to be. Institutions need solid internal governance, good risk assessment processes, effective controls. CSSF Circular 12552 on internal governance is key here, but it's constantly built upon by newer, more specific guidelines, often stemming from the EBA. It's all about being proactive, identifying, measuring, monitoring, and mitigating risks. not just reacting after something goes wrong. Capital adequacy is about having enough financial cushion, right, to absorb losses. The EU's CRR and CRDIV framework is the bedrock for banks and investment firms. It dictates how you calculate your capital CET1, Tier 1, how you weigh assets for risk, rules on leverage, large exposures, the works. Now, this is where it gets quite interesting, linking back to corporate finance structures. The Fiat Finance and Trade case, which looked at state aid, it really shows how principles like capital adequacy and transfer pricing become crucial. The question was whether an intragroup financing entity was operating at arm's length, basically like independent companies would.
So it wasn't just about the tax ruling itself, but whether the whole setup, the capitalization, the profit allocation was commercially justifiable.
Exactly. The Commission actually looked at whether Fiat Finance and Trade was sufficiently capitalized for the risks it was taking on, referencing Basel II's principles for operational counterparty credit risk. They even compared its beta to peers to figure out an arm's length return. It's a clear signal that tax arrangements like APAs can fall under state aid scrutiny if they seem to give a selective advantage. It pushes compliance beyond the bank's balance sheet right into the economic justification for how groups structure their internal financing.
Wow, okay. That adds a whole other layer of complexity.
Yeah. It really does. It demands solid economic reasoning behind those intergroup deals. And looking at how the CSSF operates, based on the source materials, you see a couple of things. They're proactive, like asking securitization arrangers to come in and present projects directly. That's hands-on. And they're very data-driven. The sheer amount of info needed for a securitization authorization arranger details, entity info, risk analysis, operations, governance, it's extensive. Same for investment firm reporting, including off-balance sheet things like underwriting. And those specific metrics for loan granting and monitoring under the loan guidelines all points to data.
So connecting this back to you, our listeners, what does this mean in practice?
It means be prepared for transparency. Be ready for significant information disclosure. You absolutely need strong internal systems to manage and report all this data accurately. Getting your head around this multi-layered system, regulation, risk, maybe even state aid, is crucial for staying compliant.
That detail on the CSSF's approach is a great lead-in talking about the different players. Who are the main actors? And what specific roles and burdens do they carry in this system?
Okay, let's run through some key ones. First up, arrangers in securitization. They're not just deal structures. They're the main point of contact with the CSSF for authorization. CSSF guidance actually says they systematically meet with the arranger when an application comes in, so they're right in the spotlight. They're burdened, providing a ton of information. Details on themselves, the securitization vehicle, the risks, valuation, securities, cash flows, custody, service providers, governance, how debt holders are represented is a long list. And for STS securitizations, even if the originator or sponsor does the formal ESMA notification, the arranger's skill in structuring the deal to meet those tough STS criteria is vital. They need to know both CSSF rules and EU standards inside out. Next, think about underwriters, the ones facilitating securities offerings. Their activities are watched. CSSF Circular 10433 specifically calls out underwriting of securities as an off-balance sheet item for reporting. Why? Because it feeds into capital calculations. It helps regulators gauge the contingent risks an institution is taking on. It's about ensuring that potential future liabilities from underwriting are backed by enough capital today. It's a classic prudential principle. Now, arguably, the most heavily regulated are the lenders, banks, and other financial institutions. Their compliance load is huge and interconnected. AML-CTF is massive. CSSF Circular 21782, implementing EBA guidelines, demands that risk-based approach. Identify risks, tailor your due diligence simplified, or enhanced, nail down beneficial owners, manage high-risk exposures, watch for emerging threats, and the sources note that corporate finance itself gets specific attention within this AML framework. Plus, it keeps changing. The latest big move is CSSF Circular 25878, bringing crypto assets and CASPs firmly into the AML-CTF net from December 2024.
CASPs, crypto asset service providers.
Yes. And it's not just for them. It's also for traditional firms dealing with crypto. It shows how supervision evolves based on what they're seeing on the ground, like issues firms had identified in that 2019 ESA's opinion. Lenders also have those strict loan origination and monitoring rules, the UL guidelines via CSSF Circular 2824. These apply to less significant banks, third country branches, certain other lenders. They cover the entire credit process.
So what do the UL guidelines actually require them to do?
Okay, they mandate strong internal governance for lending, clear procedures to ensure good credit quality from the start, trying to prevent bad loans down the line. They demand really thorough borrower creditworthiness assessments. The EBA guidelines even have annexes listing the data points needed, plus rules on pricing, property valuation if it's relevant, and ongoing monitoring frameworks, again, with specific metrics lenders have to track, listed in another EBA annex.
And remember those dual goals: prudential safety, avoiding NPLs, and consumer protection, fair treatment, responsible lending. On top of all that, lenders have the whole CRR-CRD4V framework. Own funds, risk management for credit, market, operational risk, large exposures, liquidity, how they use credit risk mitigation, and massive governance requirements, controls, risk function independence, committees, the lot. Even the securitization regulation adds rules for lenders involved, like due diligence, risk retention, transparency, and checking credit granting standards.
Wow. The takeaway for lenders really seems to be about deep integration. You can't tackle these things in silos. Not effectively, no. It demands integrated systems and processes. A weakness in AML could impact your LOM assessment and vice versa. It's all linked. Okay, let's flip to the other side. Borrowers or issuers of securities. Obviously, they provide info when applying for a loan for that credit assessment, but their public disclosure duties, they're huge, and ESMA is really pushing here. On financial reporting, ESMA's 2024 enforcement priorities highlighted needing clear disclosures on macroeconomic impacts, inflation, rates, fair value details, and crucially, how climate issues hit the financials, ensuring consistency with the management report. Then there's non-financial reporting. It's exploded. Taxonomy Regulation Article 8 reporting on green alignment turnover, CapEx, OpEx. ESMA sees room for improvement there, needing better CapEx plans disclosed. Plus, detailed climate targets, measurable, timed, scope-defined, linked strategy, and Scope 3 GHG emissions reporting the value chain stuff, boundaries, estimates, breakdowns, and let's not forget ESF reporting, mandatory digital format, XHTML with IXBRL tags for annual reports, ESMA checking for things like data embedded as images, accuracy issues, timeliness. That ESF file, it's the official one.
So issuers are accountable for way more than just the numbers now. Sustainability, climate impact. It's core.
Absolutely. It requires new data systems, new expertise, and that info feeds directly back into how lenders and investors view ESG risk. CSSF adds a tech challenge too. While Luxembourg's consumer code might not directly hit big corporate loans, it reflects a broader transparency ethos in the legal culture here. Finally, let's touch on security trustees and fiduciary agents. Their role is critical, protecting creditor interests. In securitizations, the CSSF authorization file must detail how debt holders are represented, the contract with the trustee or fiduciary, who they are. It underlines their importance. For STS deals, the guidance suggests legal opinions are basically expected. Accessible to others, covering key legal points like asset transfer triggers. Luxembourg law provides a really solid base. The 2003 law on trusts and fiduciary contracts allows creating that separate fiduciary estate, patrimoine fiduciaire, specifically for security purposes, à des fins de garantie. And the 2005 law on financial collateral. It confirms this applies to fiduciary transfers for security.
Right.
Crucially, it mandates that the fiduciary must be a regulated professionnel de la finance.
So that professional requirement adds a layer of competence and oversight.
Exactly. It ensures expertise and accountability in this vital role. It's all about legal certainty, which is paramount in financial infrastructure. While legal opinions are common practice anyway, the regulatory push is strongest in complex areas like securitization, as the sources show.
Okay, this regulatory framework is incredibly detailed. How do firms actually implement all this in the real world? What are the practical challenges and maybe what's coming next?
Right, let's talk practicalities in the horizon. Think about AML-CTF and customer due diligence in practice. It all hinges on that risk-based approach from CSSF Circular 21782. You must identify and assess your risks business-wide, relationship-specific. Then tailor your CDD, find the beneficial owners, manage high-risk factors, monitor emerging risks. But applying the RBA effectively, that's the tricky part. The 2019 ESAS opinion showed firms struggled. The flexibility means the onus is on you to get it right. The assessment, the documentation, the justification. It demands good methodology, trained staff, solid controls, great record-keeping, definitely not just ticking boxes. And it's dynamic. The new crypto rules in CSSF Circular 25878, starting DASIC 2024. That's a perfect example. Firms have to adapt operational processes now to handle these new risks identified through supervisory feedback. Or take the lending lifecycle in practice under CSSF Circular 22824 and the EBA LOM guidelines. Operationally, this means setting up robust governance for lending decisions, detailed procedures for originating sound loans, and doing thorough creditworthiness checks using all that data the EBA annexes specify. Plus, having frameworks for ongoing monitoring with specific metrics. Those detailed annexes really signal a shift towards data-heavy operations. You need the IT, the analytics to handle, process, and report on vast amounts of structured data. And remember, the dual goals, prudential safety and consumer protection, that has to shape how you design and run these processes. And where do legal opinions fit operationally? They're not mandatory everywhere, but they become crucial tools where scrutiny is intense, like complex securitizations. The CSSF can ask for them, and they're strongly expected for STS deals needing to be available to third parties. They provide regulatory assurance, mitigate legal risk. It puts responsibility on the lawyers providing them too. Managing legal risk is just part of the operational compliance package.
Okay, so implementation demands sophisticated systems, careful judgment, constant learning. What about the big picture shifts? What major trends should professionals be watching?
The biggest one, without a doubt, is sustainability and climate-related disclosures. ESMA's reports make it clear. Scrutiny is only going up. We're already seeing comments on quality issues, taxonomy alignment reporting, climate targets, Scope 3 GHG data. The impact is massive. Issuers need new data pipelines, new expertise. They have to embed climate into risk and strategy. And this info. Lenders and investors are increasingly using it for their own risk assessments and decisions. It's becoming mainstream. Then there's the digitalization of corporate reporting. CSSF, the mandatory XHTML XBRL format, is here to stay. ESMA's focus on tagging accuracy and file integrity shows it's a serious compliance point. It might have caused some initial headaches, but structured data allows much deeper analysis by everyone over time. AML-CTF evolution continues, and the big headline now is crypto assets, thanks to CSSF Circular 25878. It's a clear move to bring this whole area under the AML umbrella. It means new duties for CSPs, yes, but also for any traditional firms touching crypto. You need to step up diligence and risk management for these exposures. And finally, expect enhanced scrutiny on loan origination and NPL prevention to stick around. The LOM focus from CSSF Circular 22824 is all about strengthening the front end of lending governance, credit checks, pricing, monitoring. The goal: better quality loans, fewer NPLs down the road. Lenders will stay under pressure for high credit quality, balancing prudential rules and consumer protection.
Okay, so with all this complexity, evolution, and pressure, how can professionals navigate it effectively? What's the strategic playbook?
Well, based on what we've seen in the sources, a few strategies stand out. First, integrated compliance and risk systems. Break down those silos. You need systems that can manage data across regulations, link different risks, like ESG to credit risk. You need agility to adapt. Second, specialized expertise. You have to invest here. Sustainability reporting, ESEF tech, crypto AML, these need real knowledge. That means training, hiring, or maybe bringing in external consultants strategically. Third, proactive regulatory engagement. Where it makes sense, like complex deals or authorizations, talking to the CSSF early and openly can clarify things, smooth the path, build trust. Transparency helps. Fourth, robust data governance and quality. This is non-negotiable. Accurate, timely data is the foundation for reporting ESEF, LaView, non-financial, and for risk management itself. Bad data means bad reports, flawed decisions, likely trouble with supervisors. Fifth, embed ethics and substance over form. Don't just tick boxes. Ensure your structures have real economic substance. Remember the state aid risk we discussed. Arrangements that look like pure arbitrage can attract unwanted attention. Focusing on substance builds long-term resilience and reputation. And finally, continuous regulatory horizon scanning and staff training. Things change fast. You need a process to watch EU and national developments constantly. Spotting changes early gives you time to prepare, and regular targeted training ensures your people can actually implement these rules effectively.
That's a really helpful synthesis. It sounds like success in Luxembourg's financial world comes down to being agile, integrating compliance and risk deeply, and fostering a culture of constant learning and transparency.
I think that captures it well. And maybe as a final thought for you, the listener, to chew on. Consider how this growing focus on areas like sustainability and climate things, once seen as non-financial, is fundamentally redefining what risk and compliance even mean in corporate finance and lending. What does that profound shift imply for how you should structure your teams, manage your data, and invest in your technology going forward?
This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Hit that like and subscribe button. It was the Luxembourg Fundcast podcast for you today.